This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, I emphasize. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with me, my colleague Sonia and Nigel. Guys, hi, good morning.
Good morning.
Hi, good morning. We made it. We made it to Friday, another week, and this was a full one. No, it wasn't a full one actually. Monday was off, right?
Monday was off? Yeah, Monday was off, yeah.
But still, guys, thank God it's Friday.
You know, we almost make it sound like we're going to war or something. It's like fighting from all sides.
But did anyone go for the Backstreet Boys concert last night?
I did not. My wife did.
Oh, wow.
Yeah, but...
No.
I'm a big Backstreet Boys fan, but I couldn't.
I'm not sure how I feel about that.
The 90s nostalgia, right?
Oh, absolutely. Well, let's kick off the day with some cues as they stand right now. You have, U.S. stocks which are down again. The question which many are asking is, does it matter? Because the market here over the last couple of days seems to be singing its own song and charting its own path. The S&P is down for the fourth straight session. Day before yesterday, the S&P lost about 0.7%. Last night, it lost another 0.75 of a percentage point. And as I said, 4 days in a row, indices have been lower. The S&P 500 took support at the 50-day moving average, which stands at roughly about 4040, and then bounced off there. That's an important support level to watch. Regional banks in the US are the problem, and that continues to be the problem. So intraday, the regional bank ETF, that fell 9%. It ended about 5.5% lower. Over the last 4 sessions, that index is down 15%, and from the beginning of 2023, it's down almost 40%. And, fears are that this is kind of a slow burn situation, and eventually there will be a broader contagion. Many don't agree. We had, for example, Jahangir Aziz of JP Morgan yesterday who was saying that unlikely. Anyway, but that's the worry. Later today, you get the jobs number out of the US, the non-farm payrolls data. I was saying 2 days back that the half-life of Fed communication in terms of what they're going to do is getting shorter and shorter because, there are so many meetings, first of all, and then between meetings, there is so much data that things can change on the dime. In any case, as per the Fed, they will decide based on data, and it's going to be a meeting-by-meeting decision. There is no forward guidance now, so this assumes importance in that sense. With yesterday's rally here in India, and yesterday was a spectacular move, right? On the Nifty, on the Bank Nifty, mid-cap, small-cap indices ended 1% higher each. We are 1% away on the Bank Nifty from all-time high. On the Nifty, we're about 3.5% away. And if we do get to these levels, I think we will be one of the first large markets to do it, back to all-time highs. So I think interesting and important. And I think those are the targets. You can kind of nitpick here and there between 1%. There are some levels you can put out, but I think the bigger levels are the all-time high levels. On the downside, on the Bank Nifty, on the upside, the 78.6% retracement of the entire fall on the Nifty is 18,450. And on the way down, supports come in at 18,042, which is the low day before yesterday, and 17,960 are support levels, which should be held out. So 18,042 and 17,960 if there is some weakness which emerges. For the Bank Nifty, the all-time high at 44,152 is clearly in sight. On the way down for the Bank Nifty, 43,078 and then 42,603. This is basically the range in which there should be some downside levels and some support should be found as we go along. It's been a spectacular ride. There was just a 1 week pause. Otherwise, it's been 5 weeks of uninterrupted journey. ASICS is indicating an open that we've been gotten used to over the last couple of days, neither here nor there, down 30 or 40 odd points. Will we see a repeat of what we had yesterday? Yesterday was slow, steady, but sturdy. All day the market kept moving higher and picked up pace into the close. So that's where we are at. Last day of the week, going into the weekend, with, of course, important data later tonight. Sonia.
Absolutely. Steady but sturdy. I like that. I'm going to use that. I'm going to steal that. But the reason why I asked you all about Backstreet Boys is because there's this song, right? Backstreet's back. Yeah, all right. Yeah. So the Bulls are singing that song, perhaps, right? The Bulls are back. You saw that coming. Okay, so the bulls are back, right? I mean, 18,200 is here. And just a couple of things, as Prashant was also pointing out, the big question that we're asking is, will the Nifty continue to see buy on dips despite a little bit of challenges that's coming from across the globe? That seems like it could be the case for a couple of reasons. There's big buying that's coming from the FI community. In the last 3 trading sessions, FIs have bought to put together about 4,750 crores, which is, almost on an average about 1,200 to 1,400 crores of buying per day. So that has really given some confidence to the market. Apart from that, the earnings season has progressed quite well. In fact, even from the laggards, some of the spaces like two-wheelers where demand has not come back in a big way, over there as well, you're seeing earnings beat, not just from Hero MotoCorp, but from TVS as well. So it just goes to show that perhaps the earnings season is not as bad as what the street would have feared, and that's something that the bulls will definitely like. So both Hero and TVS were a beat. Despite export pressure kicking through, the margins for TVS have been above 10% for the 6th consecutive quarter, so the street would like that. But coming to global cues yet again, as Prashant was saying, so many data points that will come through. The US markets actually have closed lower now for 4 trading sessions, and by the end of this week, the Dow would be down about 3%, which is the weakest close that we've had since since 2 months or so. Once again, renewed fears of a contagion risk from the banking sector. Then, there's also what happens with the Fed now that one rate hike has come through. But all of that could be negotiated if earnings continue to deliver. And in that context, today is a big day. A lot of big numbers coming through. There's Britannia, Marico, Bharat Forge, Federal Bank, Paytm. A lot of non-index large caps that will be reporting their numbers as well. So we'll use all those data points. But, a couple of questions, right? One, whether the market will continue to decouple from the global space and see momentum. And 2, after the run-up that we've seen up until now, is it a good time to perhaps book profits? And that's what the question you're asking.
Well, that's right. Now, so therefore, just to build on the Backstreet Boys point, remember that song, I Want It That Way, right? The bulls want it that way, and they're getting it that way, on a day-to-day basis. So that's been good actually for from a bullish perspective.
Maybe the bulls are all 90s kids, listening to that kind of music, yeah.
I mean, I'm not sure, but on a serious note, today is Budh Purnima as well. So I want to wish all our viewers out there happy Budh Purnima. My son actually made it to school, unfortunately, and the school shut. So he's on his way back.
That's on you, not on him.
That's on me. He told me yesterday, but I thought he was joking. My wife says, just messaged me, he told you and you didn't go with it.
That's not a good Friday for him.
It's a bad Friday evening for me. But let's get back to the markets then. Could it be a good day to book profits? That's the question that we're asking. I think it could be a good day, given the kind of global cues that you have. You've got a big jobs data point that's coming later this evening. And also you have the treatment of the HDFC twins post-merger. There's a bit of a disappointment that's coming in there. And Nuvama, they're pointing out, instead of an inflow, there'll be a mild outflow that could take place. So it could possibly be a good day to take some money off the table, book your profits, have a good time, and then come back next on Monday and see how things goes. Individual stocks, hold on, but on the index, you could take off some money. Yes, it was a super session. Call writers, they got stuck on the wrong side. It was weekly expiry. There's massive institutional buying as well. DIs and FIs put it together. And there was a long build-up that was seen in the Nifty Bank futures as well. The open interest was up close to around 7%, or telling you that there was some long addition out there. What did the FIs do? They added some mild long positioning. And the previous session, they added 8,000 short contracts. But in a day, they were forced to shut off close to 35% of those long positions. So there was some short covering that played out as well. Now I'm looking at the options data. And my sense is this put writing is getting too easy. 18,200, 18,150 between them, it added closer to 75 lakh shares odd. But the 18,200 call, the rough premium out there would be around 150 rupees. It ended at around 128 rupees. So at higher levels, the bears are positioned to defend those levels. Remember, they got stuck on the wrong side yesterday. But I think that 18,300, 18,350, they'll want to defend that mark. The Nifty Bank as well, there was a fair bit of addition in yesterday's trading session. And the PCR now on the Nifty has moved to around 1.34. Now we're moving towards the higher end of the band. So that as well is a bit of a cautious sign that's coming in there. What are the levels you're looking at on the downside? 18,020, 18,050, because we have bounced off those levels, and the options data is telling us that that will be the near-term support. But we are seeing resistance at around 18,250 to around 18,300. Maybe the initial dip that the SGX Nifty is suggesting gets bought into. But I think taking off some money off the table in that resistance zone will be prudent. And the Nifty Bank has led the way. So if you're looking at it, going by the options data, 43,200, 43,300, well, that could be a near-term support zone for the Nifty bank. So let's see how this goes. But I think enjoy the weekend, take some money off the table, and come back on Monday and let's see how it goes.
All right. Lots to digest, and we'll pick up on some of this as markets start to open. Before we go any further, let's quickly tell you what's lined up in the first half hour of the show. We get you updates from markets across the globe, and Abhilash Narayan of Standard Chartered joins in to help us with that. Later, our research team will bring you CNBC-TV18's list of top 10 stocks of the day. At 8:30 this morning, we do a fundamental stock check with Siddharth Kemka of Motilal Oswal Financial Services.
Okay, so let's kickstart the show with some opinion then. First up, we have Amish Shah of Bank of America Securities saying their analysis of the past two recessions, 2001 and 2007, suggests that the S&P fell 20 to 40% after the onset of the recession, and the Nifty mimics S&P, though it falls less. He says global slowdown, volatile commodities, peak urban demand, and slow rural revival are risks for earnings. He expects continued cuts to consensus FY 24-25 earnings growth. He sees no upside to their Nifty year-end target of 18,000 and says they would look to book profits. That said, he says he would advise buying potential market dips, buying the Nifty at 16,000 on strong domestic flows, weak FI positioning and resilient India macros. Well, the Nifty is well above that, so we've moved beyond that. Now perhaps you should look to book profits.
All right, well, let's get you some money market views as well. We have Lakshmanan V of Federal Bank, who says the volatility continues to remain low in the rupee with FOMC and ECB actions along expected lines. He says with the dollar index finding support around the 101 levels, market will wait for further cues and clues from the US employment data and domestic inflation. He expects continued forex reserves and oil-related buying to floor gains for the rupee. He expects the pair to trade in a range of between 81.5 to 82.25 to a dollar for the next few trading days.
Okay, and on the bonds, Lakshmanan says that the US Fed indicating a pause, the market has started discounting the possibility of the end of the rate hike cycle. He says domestic yields on anticipated lower inflation continues to drift lower, and the 10-year benchmark bond yield is expected to trade in a range of 6.95 to 7.05% over the next few trading days.
All right, so that's all the market calls as well as the bond market and rupee market calls. But let's run you through the top 10 stocks that we're tracking for you. Hero MotoCorp, TVS Motors, Tata Power, Blue Star, CEAT. Their stocks are on the back of positive news flow. Add in Sundaram Fasteners as well. On the flip side, the HDFC Twins, because of the flash that was up for you on the screen, the MSCI treatment, that one's going to be reacting to negative news flow. Manappuram and United Breweries, all of them will be reacting to negative news flow.
Okay, well, that's basically what we are sort of tracking, and those are stocks which we will discuss in just a bit from now. Abhilash Narayan is Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank. Abhilash, good to have you with us here. Good morning. Thanks for your time. U.S. indices have been down for 3 or 4 days now, but there are those who believe that with all that is happening in the U.S., I mean, it's not enough. I mean, this is a market in the U.S. which is still very resilient, and it should not be because there is a recession coming, etc., etc. But generally, prices are telling you something else, right? So which one is it? What is likely to play out from here? Your sense?
Yeah, I think if you look at the cause of the recent decline in US stock market, I think it's clear, right? So if you look at economic data, it's been mixed. Just yesterday, we got labor productivity data, which was quite weak. So that contrasts with the stronger than expected PMI data that we got a few days back. Obviously, the focus now shifts to the jobs market data later today, as well as the CPI data tomorrow. But I think if we think about the fact we have a lot of negative news in US, the regional banking concerns, US debt ceiling debate. But if you look at the market positioning, that is extremely short. So if you look at CFTC positioning, we are close to the most extreme short level that we've seen since 2007. So that means that most of the asset managers and hedge funds at an aggregate level are already bearish equities. So we think that the extreme positioning is something that's preventing a sharper reaction on the downside in US stocks. And in fact, if we do get an upside surprise or a positive news, it's quite possible that some of the short covering could lead to a near-term bounce in the next 2 to 3 weeks in US equities. But that would be a short-lived bounce, and we would use that to get out of US equities and rotate to other areas.
Okay, that was my next question. So on cue, when you say rotate to other areas, would you move money out of US equities and into emerging markets like India? Because clearly there's a case of decoupling here, right? Growth has come back, earnings have come back, even in the beaten down pockets, and valuations are not too bad either at the moment. Do you think India is a good buying opportunity now?
Yeah, so I think we have a preference of rotating out of US and Europe into Asia in general. So leaving aside Latin America, etc., we think Asia is the bright spot because of the strong domestic growth, as you alluded to. And when we talked a couple of weeks back, I did mention that the underperformance year to date had meant that Indian equities were less expensive on a relative basis. And I think that does open up the way or reduce the obstacles for performance of Indian equity market over the next 3 to 6 months. So yes, we think that Indian equities should outperform global equities. But at the same time, given the risk of recession, it makes sense to allocate incrementally to bonds as well as gold, in our opinion.
All right. Hi, Vilash. Morning. But you're still neutral on India, right? What would make you turn that stance?
So actually, we are neutral on India relative to Asia ex Japan, but we think Asia ex Japan will outperform US. So if you take that logic to its end, it does imply that we have a view that India will outperform US and European equities. And I think the recent earnings season has been quite supportive of our view. We think that earnings growth for the next year will be quite strong, around 14-15%. And when you contrast that with the weak outlook for US, the regional banking sector stress, we could start seeing more rotational flows into Indian equities. Just one last point. I mean, if you look at the behavior of Indian and Asian equities around US debt ceiling debates, in 2011, which was the most extreme example, Indian equities were flat in the 2 months leading up to the debt ceiling resolution, whereas S&P 500 declined by 6.5 points. So we think that 6.5%. So we think that something like that could happen this year. So in the next 1 to 2 months, it is quite possible that Indian equities outperform US.
Okay, well, on that note, we will let you go. Thanks a lot, Abhilash, for joining us. So you're saying that Indian equities could perhaps outperform the US markets, but you still prefer other asset classes. Gold is a great opportunity. Gold, by the way, has hit record highs as of last evening at about 61,500 rupees per 10 grams. So let's do one thing. Let us take a quick commercial break. On the other side of the break, plenty of stocks to talk about. Two-wheeler numbers have been good. Tire numbers have been strong. HDFC to react to news flow as well. All of that and more coming up in just a bit. Stay tuned.
Welcome back. Hope you're having a good Friday morning. Well, as promised, let's get straight to the stocks that we're tracking for you. Sonia, auto sales numbers, the two-wheelers, Hero MotoCorp and TVS Motors, how did they do?
Oh, very strong numbers coming in from both those players. Just to keep the context, the numbers were expected to be on the muted side, especially because TVS Motor had that whole export, weakness. But given all of that, the numbers were not bad at all. Let me start with Hero MotoCorp. Just to give you a sense of the key numbers, it was strong earnings, beat on all parameters, margins up 180 basis points on a year-on-year basis at 13%. Revenue growth of almost 12%, slightly higher than estimated. The core EBITDA went up 22% at over 1,081 crores, and the margins as well, as I said, 180 basis points higher. The volume growth was also decent for Hero MotoCorp, almost 7% on a year-on-year basis. The management said that it was because of healthy recovery in urban demand, traction that they saw during Navratri, and channel filling as well. They also spoke about the commentary was positive, and I think that's something that the street will like. They expect the two-wheeler industry revenue growth to be in double digits in the coming year, and they're accelerating their electric vehicle rollout as well. They plan to be in 100 cities within this calendar year itself. So I'm going with green for Hero MotoCorp. For TVS Motor as well, the earnings were above street estimates. The margins are above 10% for the 6th straight quarter, and it's record high margins at 10.3%. And this says a lot at a time when they're seeing big export slowdown. To hold on to 10.3% margin is no mean feat. A revenue growth of almost 20%, core EBITDA up 22%, and profits up about 49%. Also, their electric vehicle piece is moving very well. So their cumulative EV sales has crossed more than 1 lakh units. and that's because of the TVS iQube, which has done exceptionally well. So I'm going with green for these stocks.
All right, TVS Motor stock will react, and those are earnings. Well, Tata Power is the next one, which reported earnings, and we have, by the way, the management joining us a little later in the program. But the numbers first. Vivek is here with exactly that set. Vivek, morning.
Well, good morning. Actually, when Tata Power reported its results, it's been a slight beat to what the analysts were anticipating. In fact, the revenues have come in, in line with what the street was anticipating, closer to the 12,450 crore mark. EBITDA, has come in almost 100 crores above what our poll was anticipating at the 1,930 crore mark. Margins too have come in quite steady at the 15.5% mark. And when you're talking about the net profit, the adjusted net profit had come in largely in line to slightly above what the street was anticipating. So expect some green on the stock here. However, there are a couple of worries that have emerged. The number one worry is the fact that coal prices, even in the call yesterday, the management alluded to the fact that coal prices have been on a declining trend. So the Indonesian JV profitability going forward will start coming down. However, there are some bright spots as well. The solar EPC order book is coming in quite strong. Almost 17,450 crore is the kind of order book that they're enjoying there. And, strong operational performance of the Odisha Discom. That too is a key highlight in the quarter gone by.
Okay, thanks for that, Vivek. Later today on Bazaar, we will be joined by the management of Tata Power to discuss their quarter gone by. So do stay tuned in for that. In case you have any questions from the management, you can always write into us on social media, on our Twitter handles, etc. And we'll try and take it forward. But Praveer Sinha, MD and CEO, will be joining us on the show. Let's also move forward and talk about Manappuram Finance. That's in focus. Abhishek is here to give us the latest on that. Abhishek, morning.
Morning, Sonia. So there is a release coming out from ED. As per that, they have conducted searches at 6 premises belonging to Manappuram Finance and its director VP Nandakumar. So ED is looking at money laundering allegations of funds that have been collected illegally by the Nandakumar or Manappuram group. So assets worth rupees 143 crore have been frozen by ED. RBI had detected this collection and directed Manappuram to return the amount to depositors. However, Manappuram had informed RBI that they have returned the amount, but ED findings does show that the claim there is no proof of repayment being done and no KYC of the depositors. So rupees 53 crore are shown as repaid in cash, but again there is no evidence is what ED has claimed. So ED claims that the proceed of the crime is diverted and invested by Nandakumar into immovable properties and his family members' name and into Manappuram shares as well. Earlier in the day, yesterday, Manappuram had given clarification that ED searches related to depositors accepted by Manappuram Agro Farm before 2012 is of amount of rupees 9.25 lakh, and Manappuram Agro had repaid the entire amount to the depositors. Back to you.
All right, Abhishek, thanks a lot for that. So the bad news continues. In fact, yesterday, post some clarification, the stock did spike up, but Abhishek's bring us his details and it could be back to the sell list today. Vivek, though, joins us to talk about the HDFC twins. Well, Vivek, the expectations really didn't come about. And today, instead of inflows, we're working with outflows now, post this MSCI announcement. Tell us more.
Well, absolutely right. It's a significant development as far as both HDFC as well as HDFC Bank is concerned. So in an overnight development, what has actually happened is that MSCI has said that in the merged entity of HDFC as well as HDFC Bank, in the MSCI Standard Index, they will be using an adjustment factor of 0.5. Now, what this indicates is that, there could be a likely selling of close to $150 to $200 million from the merged entity, once the merged entity comes into the MSCI Standard Index. MSCI has also said that they will be announcing more implementation details in due course. Now, while the quantum of $150 to $200 million is not too high in terms of the merged entity outflow, what will actually disappoint the street is the fact that the street was actually working in with the fact that the adjustment factor that MSCI will use to include the merged entity would be 1, and which is why, Nuvama Alternative Research had actually estimated that there could be inflows of close to $2.8 billion that could come about in the MSCI Standard Index. So now, instead of an adjustment factor of 1, the adjustment factor would be 0.5, which could lead to incremental outflows. Expect some pressure on both of the stocks today.
Okay, thanks a lot for that. So some pressure on the HDFC twins because of this. But Surbhi is joining in. She's tracking United Breweries and Blue Star this morning. Surbhi, how did it look?
Thanks so much for that. So United Breweries have reported a very weak set of numbers. They've reported a revenue of 1766 crores versus expectations of 1815 crores. Now, inflation pressure of barley and packaging material led to a gross margin contraction of over 1,000 basis points, came in at 39%. EBITDA was down almost 80%. So along with higher raw material prices, they have actually reported employee expenses which are higher than 35% when compared to last year, which has led to a further contraction. When it comes to margins, Q3 would have been the bottom for them, and that was the expectations. But Q4 margins are a negative surprise for the second consecutive quarter. Margins were down almost 1,200 basis points, came in at 3% versus 15% last year and an expectation of 9%. They have reported a volume growth of just 3% versus expectations of 7 to 8%. And this was due to market headwinds in Delhi and also changes in operating model in Tamil Nadu. Now, management in a statement has said that they expect the inflationary pressure to continue and they will seek appropriate action to further mitigate the impact. Next one is Blue Star. They have reported strong earnings and it was better than estimates. The revenue was up 16%. They have seen their gross profit margin expand by 300 basis points. EBITDA margin for the first time in the last 5 to 6 quarters have crossed the 6.5% mark, came in at 6.8%. Their reported PAT was, however, higher due to a one-time sale of profit. If you strip that off, net profit is actually down because of higher taxes. Now, when you look at internals, both the segments have reported strong growth. In their EMP segment, which is 50% of their revenues, they've seen a revenue growth of 10% and the margins have come in at 8% versus 6.7%. Management has said that they've received significant orders from railway electrification segment. And the unitary product segment as well, the revenue was up 22.3% and they've seen a margin expansion of 140 basis points. Now, management in its press release have also said that they've gained market share across all segments. So very strong numbers from Blue Star.
Thanks a lot for that, Sharbi. Well, Sonia, tell us about CEAT as well as Sundaram Fasteners. Both of those numbers look good.
They looked very good, and I think CEAT could be one of the stocks of the day. The numbers are really strong, and if you remember, MRF also posted very strong numbers, had a good stock reaction. So for the tire space, it's largely a margin-led beat that we're looking at because of lower raw material prices and operating leverage. Healthy volume growth as well on both year-on-year as well as quarter-on-quarter basis. Exports are now showing early signs of recovery, and that's very important because, export was a market that was suffering the most. The management says that the replacement volumes also recovered after a seasonally weak Q3. But what I really liked about the numbers is the margins. They've gone up 550 basis points year on year. The raw material cost basket has reduced by 8 to 9% and the gross margins expanded significantly. And, that led to the operational efficiencies, which led to a big pickup in EBITDA. But the other positive that the street may latch onto is lower debt. So the debt of the company has been reduced by 10.5% quarter on quarter, coming in at about 2,093 odd crores. The other stock we're looking at is Sundaram Fasteners. Very good numbers there as well. Going with green on the stock, 7.5% growth in revenues. Margins have improved to 15.5% and profit growth is also quite decent. So going with green on these two names. But here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow. There's Hero MotoCorp, TVS Motor, Tata Power, Blue Star, CEAT and Sundaram Fasteners. While stocks with negative news flow, HDFC, HDFC Bank, Manappuram Finance and United Breweries.
Okay, we'll take a very quick break here. Siddharth Khemka of Motilal Oswal Financial Services will be joining in for some fundamental stock chat. Later, we'll connect with Keki Mistry of HDFC Limited to discuss their fourth quarter earnings, which came through yesterday. Stay tuned.
Right, welcome back to Bazaar Morning Call. We have plenty of stocks to talk about. So let's get Siddharth Khemka, the head retail research at Motilal Oswal Financial Services, into our discussion. Siddharth, hi, good morning. Great speaking with you on the channel. I want to start with the stock that we just spoke about before the break. I don't know if you heard it, the tire space, right? Good numbers, strong earnings from the likes of MRF, CEAT, but some of these stocks are not cheap. Any thoughts here? Would you buy them or avoid?
Yeah, very good morning, Sonia. Pleasure to be on the show. I think the overall outlook on the tires is turning out to be positive because of several reasons. And the first one would be the strong recovery that is being witnessed in the OEM sales growth. So after you see last several quarters of supply chain issues, several other issues, things have started falling in place for the auto companies. Raw material prices have come down. They have been able to pass on price hikes. The semiconductor chip availability has improved. So if you look at the overall space, things have been improving. Similarly, for the tire companies, raw material prices was a key concern. That has come down, helping them improve their overall margins. With volume growth now looking much better. Definitely, some of the stocks are not looking cheap and they have outperformed. For example, Apollo Tyres trading at its all-time high levels. But if you look at the overall space, as I said, I think we still believe that there is room for further upside. We still have a buy rating on Apollo Tyres with a 400 rupees target price. Gives still some upside from current levels. CEAT again, we believe that post the strong numbers, there is still room for strong growth, margins to sustain at current levels, which should provide further upside to CEAT as well. So I think these are the two stocks from our tires coverage universe that we have been liking, and we see further upside from current levels as well.
All right. Hi, Siddharth. Morning. I wanted to ask you about these air coolers and AC manufacturers. I think a couple of months when we were getting into the summers, I recall you saying that, some of these stocks look good. Voltas did pretty well. But we have Blue Star that's come out with a very good set of numbers, good order book as well, good top line growth. Between them, who would you go for? I mean, Blue Star's out there, which is giving good growth, good profitability as well. You have Lloyds, that if you want to play it, you have to play it via Havells, where good growth, but it's giving you negative on the margins, while Voltas is losing market share. So between the three, who?
Yeah, very good morning, Nigel. I think we have seen the strong demand, especially for these ACs and air coolers, given that this year's summer started pretty early in Feb itself. We saw heat wave last month across several states in India. So that has led to the strong demand for the air conditioners, and that has helped these companies report strong numbers. Although, as you rightly highlighted, some of them are losing market share, are still not that healthy in terms of margins. Plus, both
all right,
Voltas
Siddharth,
and
just
Blue Star.
stay on with us. We'll just come back to you in a minute because I do want your thoughts on HDFC as well. The company reported a very strong set of Q4 numbers. The bank reported its lowest gross NPA ratio in 18 quarters and net interest margin at a 7-quarter high. My colleague Abhishek caught up with Keki Mistry, the Vice Chairman and CEO. Let's listen in.
If you look at the month of March 2023, which is the last month of the financial year, we had the highest ever level of individual loan disbursements in history. Previous highest had been March of 2022. So the growth momentum continues to be strong. You will always see 1 month, 2 months here and there where the growth may be a little more, little less. But generally speaking, the growth momentum is still very strong.
How will the lending rates harmonize between SDFC Limited and the bank on certain products like loan against property, etc.?
So as it happens, every customer who moves into the bank will move at the existing interest rate. So theoretically, if your interest rate today, for argument's sake, is 8.5%, then when you move to the bank also, your interest rate will be 8.5%. Now, the benchmark may move from HDFC RPLR, as we call it today, to a repo-linked product. We see all banks today have both repo-linked loan products as well as they have their traditional own cost-based products. So initially, customers will move to a cost-based product, but they will have the option to move to a repo rate product.
What has been the impact of higher rates on customer preference? Have they postponed their purchase or demand per se, or are you witnessing the momentum to continue despite the rates that have increased?
So the way I would look at it is that a housing loan is very different from a short-term. Typically, a housing loan stretches for about 13 to 15 years. Now, in a period of 13 to 15 years, when you take a floating rate loan, interest rates will go up and interest rates will go down. Interest rates are never fixed. Now, today, if rates are high, then at some point of time, rates will come down. Already there is talk of global rates coming down by the end of the year. So at some point of time, you may see rates in India also come down. So if you've taken a floating rate today at a higher rate, your rate will come down. If today, for example, the rate was low, the rate can go up. So it really doesn't make too much of an economic impact whether rates are high at the point of time when you take a loan or not. Sentimentally, it does make a little difference, but it's not that significant. For a shorter term loan product, my sense is the impact might be low.
Can we expect softening of rates by RBI this year? If so, by how much could the rates from RBI get softened by?
Again, very difficult to answer that question off the cuff. But if the rate increase, we've, to my mind, reached the peak of the rate increase. Now, data will have to be watched. I'm sure RBI will be very carefully monitoring, watching every bit of data that comes out of the system, inflation numbers, monsoons, and there are so many other oil prices, geopolitical issues. So there are so many factors RBI would consider. I don't know whether it's in the next 3 months or 6 months that they will start reducing rates. Economic growth continues to remain strong. So my sense is rates, so some degree of rate stability would happen for a while. And then at some point of time, RBI could start looking at reducing rates. But to put a number to it or to put a month to it is virtually impossible.
How do you see the impact on housing finance sector from the interest rates, or what can this spell for your net interest margin and steady state of net interest margin? What could be your endeavor over there?
See, historically, we have always targeted a net interest margin which is between 3.3 and 3.5%. Every quarterly numbers that we've been giving you over the last several quarters, net interest margin range has been 3.2 to 3.5. This year, the net interest margin was 10 basis points higher than last year and stood at 3.6%. The last quarter, the net interest margin was even 3.7%.
Well, with the expected integration, how do you see the housing finance segment growing in FY24?
In my opinion, the growth opportunities for housing in the bank, in HDFC Bank are enormous. Today, the bank does not distribute housing loans from all their locations. But post the merger, it's certainly something that they would be able to do. Secondly, they have, if you look at the customer penetration, only 2% roughly of their customers have taken housing loans from HDFC. Another 5% have taken loans from other banks. So look at the ability to cross-sell to the 93% who have not taken a loan at all, and to the 5% who have taken loans from other banks. So it's according to me, a huge opportunity for the bank to grow.
What kind of cost may get rationalized over a period of time once the benefit of the integration starts to kick in for the merged entity?
See, realistically, HDFC's cost structure is extremely low. We have probably the lowest cost-income ratio in the financial system in Asia and one of the lowest in the whole world for a retail financial institution. So obviously, when you marry the two institutions, the bank has a higher cost-income ratio, HDFC has a lower cost-income ratio. When the balance sheets and the P&L accounts get merged, logically, the cost-income ratio should come down. Having said that, the bank is expanding, they're setting up more branches, which may incur some amount of cost. So the immediate benefit of a sharp drop in the cost-income ratio may take a little while for you to see. But that's something the bank would be fully cognizant of, because they're setting up so many retail branches where you incur upfront costs, but the benefit of those branches only come over a period of time as you raise more deposits, as you get more business through those locations.
Well, sir, the only point in your result was the massive decline in non-individual portfolio, almost by 11.5% on a YY basis and about 4% on a sequential basis. So what is happening over there? Why has the portfolio declined? And would you be comfortable if that book continues to run down?
Look, there are two parts to it. Part of this we had discussed even in the last earnings call. If you look at the non-individual book, we have three categories of loans. We have construction finance, which is currently about 7% of our total loans. We have lease rental discounting, and we have corporate loans. So these are the three segments of loans that we carry in the non-individual category. Our total non-individual loan today stands at 17% of the book. 7 is construction finance, 6, if I recall right, is lease rental discounting, and 4 is corporate loans. Now, construction finance loans, as we've been saying time and again over the last 2 or 3 quarters, the pipeline is healthy because the construction activity has started picking up. You've seen the huge demand for residential properties in recent times, and you see this reflected in the results of most of the property developers in recent times. So the demand is very strong. And as the demand, to satisfy that increased demand, more and more developers are looking at launching more and more and bigger and larger projects. Now, whilst we may approve loans for those projects, the disbursements for those loans will only come over a period of time. Whereas in a lease rental discounting loan, the disbursement is made upfront. So construction finance pipeline is healthy. Growth will come, but will come over the next 2, 3, 4 quarters. So that's one reason why the non-individual book growth has not been strong, because today what we would otherwise be dispersing is loans which would have got approved, let's say 2 or 3 years ago, when the demand for housing was not so strong, and therefore not too many projects were being launched. The second element is the fact that in our books, we have certain loans which don't comply with the RBI requirement or the bank's lending rules. So as these liabilities mature, as these assets mature, we've taken back the repayment of those loans and we've not given fresh money. So consequently, and most of the non-compliant funding from the RBI or the bank perspective is broadly now completed. So I don't think we will see too much more of repayment of existing loans which are not compliant with the bank. So you would at some point of time, to my mind, and not too distant future, in a quarter or 2, start seeing the non-individual segment beginning to.
Okay, that's interesting. So retail housing segment has moderated. The growth has moderated a tad bit, but still very strong in terms of net interest margins, a 7-quarter high over there. And a lot of talk about the way forward as well. Siddharth Khemka is still with us. Siddharth, apologies, we had to interrupt you there because we sort of were awaiting the management commentary from HDFC. But you heard what Keki Mistry had to say. How are you feeling about this space in general and this stock?
Yeah, so I think the company reported very strong numbers. The management commentary yesterday as well as today, we heard him live. So it's pretty strong. And as the management highlighted, the high interest rates has not impacted the demand for mortgage loans so far. Yes, there is some moderation at the margin, but I think overall what the company is saying that they are witnessing increasing in the tenor, and about 10 to 15% of the loans that is getting extended to a higher tenor to adjust to the higher interest rates and the higher EMIs. But overall, pretty strong numbers. I think there is a huge upcycle in the overall real estate housing demand that we are witnessing that is being corroborated by the strong bookings that we are witnessing across real estate companies that have reported numbers. So I think overall, we are very positive on the housing real estate space, and that makes us positive on the housing space as well. In terms of interest rate cycle, we are almost at the peak with RBI taking the first step and pausing the rate hike. There could be one more hike based on what the US Fed does. But I think the merger will bring in synergies. The overall space and demand looks good. So overall, we have a very positive view on HDFC Limited. We have a target price of almost 3,300, which is a 15% upside from current levels.
Okay, all right. So thanks for that. Noted your view, but just stay with us. For today, it won't be really the results. It's going to be that announcement that came in from MSCI that is likely to weigh in on the stock, as Vivek told us earlier. The street was hopeful for a multiple of that 1x, in terms of inflows. Now, in fact, there will be no inflows, but there could potentially be a small outflow of around $150 to $200 million or so. HDFC Twins could be under some pressure. Well, we'll slip into a short break. You come back. Mitesh Thakkar as well as Kush Bora will be joining in for our technical trade, so you stay with us.
Okay, welcome back. There is just a few minutes to go for the pre-open session. Anuj is in the studios with a take on how he sees things. Anuj, hi, good morning.
Morning, Prashant. Well, you know what, this is the magic of bull market. Yesterday, there was all the expectation of a breakout, and finally, HDFC's numbers did the trick, and after that, we saw the move in HDFC Bank as well. So, in the just last 30 minutes, the two stocks contributed 50 points of Nifty's rally, and again, this morning, these two stocks could have a bit of a reaction, so that's something to to keep an eye on. And the market yesterday rewarded those who chased a breakout of 18,200. We had the highest ever close for 2023. Remember that? And very close to all-time high. And what's been more heartening about this rally is that the broader market has participated. Unlike the last rally, this rally actually has been led more by the mid-caps. The mid-cap index is set to beat Nifty to a new high, and it's rallied 12% in a month and a bit. So that's, I think, the good part. What next? I think we've got a bit of a decoupling going on right now from the US market. My only worry is that it's now a consensus call and the market is extremely overbought. No sign of sell signal yet, but you just want to keep that at the back of your mind that it's an extremely overbought market now. And just like an extremely oversold market did give you a big rally, there's always a risk that extremely overbought market could have a reaction at some point. Also, I do believe that portfolio investors could now look at selling some of the lower quality stocks. As they say, sell your mistakes in a bull market and buy your regrets in a bear market. Now, on Nifty and Bank Nifty, I think the texture is still buy on dips. And X of IT, most indices at lifetime high. The next big question for me is the Bank Nifty ready for life above 45,000? Because that's clearly been the leader of the market.
All right, Anuj, thanks a lot for that. So let's see whether the Nifty Bank can take this market higher. It has done its job up until now. Mitesh Thakkar and Kush Bora join in to help us answer those questions. Gentlemen, morning to both of you. Kush, let me start with you. The market has been fine. I mean, 18,200 is here and, the Nifty Bank is leading from the front. Any thoughts on whether that can continue to be assume leadership position? And what are the stocks that you're looking at this morning?
Hi, Sonia. First up, thank you for having me on the show. Well, a simple one-word answer is yes. The markets can rally higher from here. And yes, Bank Nifty, is most likely and, very well placed to, lead the rally from here. Only a handful of sectors could actually, take the onus of taking the markets from, to higher levels from here. Bank Nifty certainly will be at the forefront. Now, as far as the overall setup goes, and this I'm talking near term, look, yesterday's direction was absolutely fine, but the momentum was a surprise and a pleasant one at that. So my suggestion would be to buy on dips. The PCR is inching closer to overbought territories. So it's best to buy on dips. So 18,100 on the Nifty and 43,300 on the Bank Nifty. If we get, the indices closer to these levels is when, I would suggest, entering, as for fresh trades. Existing positions, because the momentum is so strong, don't fret, continue to ride. But yeah, certainly this is a buy on dips kind of a market right now.
Okay, buy on dips kind of a market. Mitesh Thakkar is also with us. Mitesh, do you agree that one should continue to buy this market? And if yes, what are the stocks that you are looking at today?
Morning, Sonia. I do believe that, yes, the overall directional bias remains on the upside. However, we would advise some profit booking at these levels for two reasons. One, I think the Nifty is hitting this 18,250 band. The Bank Nifty's highest ever weekly closing, which was way back in December of 22, was 43,633. And we are practically around those levels, and the highest daily closing was around 44,050. So I think this band of 400 points might act as some kind of a profit booking pivot, though I think eventually breaking into all-time highs will provide fresh momentum. But in the short term, having seen the Bank Nifty rally from 39,000 to about 44,000, closer to 44,000, I think, the instinct is to take some profits and wait for a pullback to play out before you enter aggressively on the long side. So the idea is that tactically, I think, you would want to shed some positions on the long side, take some profits home, wait for a pullback, but otherwise, directional bias remains on the upside. So dips, I think, would be a welcome chance to buy into the markets. On the stock side, I have more of buy calls and one sell call. So Asian Paints is, finally coming out of a correction. That's a buy with a stop at 29.50 for targets of 30.50. Coromandel Fertilizers is a buy with a stop at 9.55 for targets of 1,015. And on a mild dip, let's say about 5-6 points, buy Havells with a stop at 12.30. So buy around 12.50 with a stop at 12.30, targets of 12.95 here. And one sell call, that's Godrej Consumer Products, sell here with a stop at 9.45 for targets of 9.20.
Okay, all right. Mitesh, good morning. Run us through your picks as well for the day.
I just did that, Nigel, sorry.
Kush, sorry, Kush. I meant Kush, I wanted your picks for today.
Sure, Nigel. Two picks, both on the buy side. First is Kotak Mahindra Bank. The stock has seen a bit of revival and a bit of stability over the last couple of days. So 1975 is where I would place my target. 1930 is where I would place my stop loss. The second is a cash stock, Power Mech. Again, this stock has given a very decent breakout on the back of decent volumes. So, buy for a target of 3,000. My stop loss here would be 2,700.
Okay, all right, gentlemen. Thanks a lot for that. Well, let's get in some derivative strategies. Manoj Muralidharan, VP at Derivatives at Relicare, joins us on the show. Hi, Manoj. Good morning. What are the strategies you have for us?
Good morning, Nigel. Nigel, if you simply bifurcate the trade that happened yesterday, if you see the breadth in the market was a good 2.5:1, but then we believe that automobile as a sector which had good delivery buying and money flowing into the April end towards the May rollover, that has seen some profit booking. So I believe IT as a sector and finance, this would be the two where there can be fresh money coming. Nifty certainly becomes a buy on dip. The single largest put writing that we saw yesterday was an 18,200 strike. So levels of 18,200 can be a good buy. Obviously, we are expecting some resistance or profit booking towards an 18,300 to 350. So TCS becomes a buy. At 32.10, we advocate buying that at 31.80 as a stop loss, and I believe 32.80 to 3300 is in the offing, so that becomes a buy. Even SBI levels of 574 to 75 becomes a good buy. The stop loss should be 68, and we expect close to 584 to 88 on that as a stop.
All right, let's slip into a short break on that note. On the other side of the break, we'll come back with the pre-opening rates. We'll also have Aniket Mhatre of HDFC Securities to talk about the Q4 earnings in the auto sector. Stay tuned.